There are signals in this market, quiet signals that reveal when crypto is about to move long before the charts ever show it. Most traders never notice them. Most influencers never talk about them. But institutions, they watch them every single week. And today, you're going to think like an institution. This is for education only, not financial advice. Crypto moves fast, and you should always manage your own risk. Now, let me ask you something. Have you ever wondered why Bitcoin sometimes pumps for no obvious reason? No news, no announcement, just up. That's because retail watches price, institutions watch liquidity. Let's dive in. Number one, the global liquidity index. Think of this as the heartbeat of the entire global financial system. When global liquidity rises, Bitcoin doesn't just drift up, it forms its cycle bottom. It starts trending, and then all coins follow behind it like a rope being pulled off the ground. Here's the proof. In 2020, when global liquidity exploded by over $10 trillion, Bitcoin went from $4,000 to $69,000 in 18 months. Every bull run you remember lined up with this chart turning upward. This is the master signal, and historically, it it leads Bitcoin by 2 to 4 months. Number 2, central bank balance sheets. This one is incredibly simple. When central banks expand their balance sheets, they're pumping liquidity into the system. When they shrink them, they're draining liquidity out. In 2020 to 2021, the Fed expanded its balance sheet by $4.8 trillion. Bitcoin went from $10K to $69K. In 2022, the Fed started quantitative tightening, shrinking by over $1 trillion. Bitcoin crashed 77%. You don't need theories, you don't need headlines. Just watch the balance sheets. They are liquidity. Now, this next one, game changer. Number 3, the reverse repo, the hidden pipeline. RRPs, where extra cash sits when banks don't need it. When RRP starts draining, that cash flows back into the real world and eventually into risk assets. Here's what happened in March 2021. RRP was near zero. By October 2021, Bitcoin hit its all-time high. Then in 2022, RRP exploded to $2.4 trillion. Bitcoin crashed. Now, RRP has drained from $2.4 trillion down to under $200 billion. When RRP falls, liquidity is coming back. Most people ignore this chart. They shouldn't. Number 4, the Treasury General account, the invisible liquidity lever. The TGA is like a massive reservoir controlled by the US Treasury. When they draw it down, money floods into the system. When they refill it, money gets pulled out. No announcement, no press conference, no warning. In early 2021, the TGA dropped from $1.8 trillion to $100 billion. That's $1.7 trillion injected into markets. Bitcoin went parabolic. If you've ever seen a rally come out of nowhere, the TGA is often the reason. T- TGA down supports markets. TGA up tightens conditions. Number 5, the yield curve. A steepening yield curve has appeared before every major crypto bull run. Why? Because a steepening curve tells you credit is opening up, lending is becoming profitable, recession fears are fading, and investors can finally take on more risk. Where the curve flips from inverted to steepening, that's when risk assets wake up. In 2016, the curve steepened. Bitcoin went from $450 to $20k. In 2019, it steepened again. Bitcoin bottomed at $3,200 and ran to $69k. It's not instant, but it's reliable. Number 6, M2 money supply, the long cycle heartbeat. M2 is slow but powerful. When M2 shrinks, the entire financial system feels tight. When M2 bottoms and turns upward, the environment shifts from restrictive to expansionary. In 2023, M2 contracted for the first time in decades. Bitcoin struggled, but historically, when M2 reverses upward, Bitcoin finds its cycle bottom within 3 to 6 months, and then multi-month rallies follow. Now I know what you're thinking. Where do I actually track all this? Here's what you need: global liquidity. Check composite indexes on TradingView on macro dashboards, central bank balance sheets, the Fed's H4.1 report updated every Thursday. RRP, New York Fed publishes this daily at 1:15 p.m. Eastern. TGA Treasury Direct Gov updated weekly yield curve. Fed database by the St. Louis Fed. M2 money supply also on Fed updated monthly. I'll drop direct links to all of this in the description below. You don't need a Bloomberg terminal. Just check these 6 things once a week. Here's your 30-second sheet. Screenshot this. 4 or more indicators bullish equals high conviction, time to build positions. 3 indicators mixed equals wait for confirmation, stay patient. 4 or more indicators bearish equals reduce risk, preserve capital. This is how institutions filter noise. Here's the biggest mistake I see: people watch these indicators but still panic sell on red days. Remember, liquidity is the macro picture. It doesn't mean Bitcoin can't drop 15% next week. It means 3 to 6 months from now, if liquidity is expanding, the trend is likely higher. Don't confuse short-term volatility with long-term direction. So where are we right now? Global liquidity is stabilizing at cycle lows. The Fed is approaching its easing window. RRPs has drained 92% from its peak. The yield curve is preparing to reverse, and M2 is showing early signs of bottoming. These are the same ingredients that appear before expansion phases begin. Final word: liquidity moves first, price moves later. Most people focus on the ending, the breakout, the pump, the rally. But the real edge comes from seeing the setup before the move starts. That setup is liquidity. Now here's what I need from you. Pick one indicator you want me to deep dive next week: global liquidity, reverse repo, or the yield curve. Drop it in the comments right now. The top voted one gets a full 15-minute breakdown with live charts and exact signals to watch. And if you want to stay ahead of 99% of crypto traders, hit that subscribe button. I break down these liquidity signals every single week before they hit the mainstream. See you in the next one.